Hello again for part 2. We're going to talk a little bit more about home equity. Now remember that your equity is just kind of a figment of imagination until you do something with it. And what do you do with it? It is only liquid if you take action, because mortgages are a dead-end street. So we're going to talk about that. But just to remind you that example of your $300,000 mortgage, let's say that you are buying a home that's $300,000. You're going to put 20% down. Most mortgage lenders require 3 to 20% depending on what kind of loan you're getting. But we're going to start with 20%. Because that makes a nice juicy cushion and gives you more equity. So 20% of that would be $60,000 down. So that leaves you with $240K on a loan balance. Okay. Now, we're not going to worry about like what the payment is at this moment, but let's say over a few years that you've made $15,000 worth of payments. Okay, so now let's pretend and say 3 years. That's actually kind of high, but we're going to do that for fun. Okay, so that would put you at $225. Now, new balance. But now, 3 years later, your home is worth more than the $300,000 in a perfect world. Let's say that it's now worth $330, 10% more home value. Okay, so you're going to take your value, and remember this is kind of an imaginary number that you go out there. You can ask a realtor to get comparables. They can tell you what the value is. If you're watching all the time like I do, I can pinpoint a value really fast. But if you're not like watching the market and you don't know, ask a realtor or a mortgage lender and they can help you find out what the value is for your home. Sometimes you can go on Zillow, you can go on, realtor.com. There's a few other websites that will help, but really the tried and true way that a lender would go is by comparables, okay? And comparables have to be within a 1.5 mile radius. All right, so we're going to go with the new value of $330 minus your new balance after a few years, $225, and so that is going to give you $105 of equity. All right, so, and this equity is also kind of an imaginary number. Because you're putting money into a mortgage, but you can't ever go and take money out, right? Every month you go and you put money in, and they don't say, hey, you have an emergency, go ahead and take $1,000 out. Nope. Once you hit that send button, that money is gone and it goes to the lender. Because remember, if you've watched any of my other videos, that over that 30-year amortization, you are paying your house off, but you're also buying a house for the bank. Not so cool. Okay, so this is not liquid. What does liquid mean? Liquid means that's money that you can get out easily. And easily means like there's no government rules against getting it out that's going to cause you fees. An example of that would be your 401k. an IRA. They have all these rules about when you can take it out, what fees you're going to pay if you take it out early. Okay, so liquid means that if you need money, you can get it out. So your equity is kind of imaginary. It's there. It's not liquid. But so what do we do with it? And just so you know that it can go up and down, like we talked about. It can increase imaginarily. It can decrease imaginarily. But you never want it to decrease below what you owe. Okay, that's 2008 problems. We don't want that. So what we're talking about today is that it is important to kind of keep an eye on what your equity is, because there's some things that we're going to talk about later about what you can do with it, how you can borrow against the equity in your home and do interesting things with it. Typically, you have to go and get what's called a home equity line of credit, or HELOC. There are many different kinds of HELOCs, and we're going to probably focus on one or two of those in the next few sessions here. But I did want to go over first how, because you're probably saying, well, I don't understand this liquid thing. Okay, so let's talk about credit cards for a second. Now, credit cards, they have a high interest rate. Let's say 24%. That's kind of on average, I would say. You can get them from low would be 12%, high would be in the 30s to 40s. So we'll just put it around 24%. Now, the nice thing about credit cards is they are on simple interest. Mortgages are compound interest, not your friend. Okay, simple interest. So that means that whatever the balance is, they are calculating that balance at that time every month on simple interest. Whereas mortgages, they're compounding that each month. Okay, so let's say let's say you have a max limit of $1,000 and you spend $200, and this is 1 month, and a good little consumer would go and pay off at the end of each month that $200. So that brings us down to zero, right? So that means there's no interest at all on that, because your balance at the end of the month is zero. But let's say you don't pay it off. Let's say it just sits there. So the interest is on the $200 interest, okay? And you can use your calculator and figure out what that is. So, and then each month that you didn't pay on that, then that would just add and add and add. But the thing is you can still, because your limit is $1,000, if you have an emergency or whatever, you need the money, you can go and get up to that $1,000. But you also have the choice to pay it off whenever you want. That's liquidity. So that's liquid. Okay? And remember, the simple interest is our friend. So as long as we understand that sometimes people think that credit cards are bad. Yes, they can be for people that don't have discipline. But if you have discipline, credit cards can be your friend. And a lot of times you find a card that has 0% interest for, let's say, usually a year, sometimes 18 months. That really can be your friend, and you can do some great things with that. But also you need to analyze the risk and see if, what if you lose your job or you don't have the income? That does happen. So we do want to beware of credit cards. But they can be liquid for you if you need it. Okay, but that's going to play into the next one. So I will build on that. I want you to think about things, what I'm kind of letting simmer in your brain, and we'll move on to the next thing.